Hello, everyone, and welcome to this panel on integrating staking into crypto ETFs. I am Artiona Bogo, Head of Solutions Architecture for Web3 at Chainlink. For years in crypto, we have obsessed with the idea of bringing everything on chain, like bringing real world assets on chain, tokenized bonds, tokenized treasuries, you name it. But with crypto ETFs, we're actually doing the reverse. We're taking something that natively exists on chain, rubbing it off back into traditional financial products, right? It may sound ironic, but make no mistake, it's necessary. We need TradFi, its massive liquidity, its regulatory clarity, its validation to drive the next stage of growth for Web3. At Chainlink, we play a critical role in working with major traditional finance institutions like SWIFT, UBS, DTCC, powering their blockchain strategies, their pilots, their road to production. And at the same time, Chainlink is already the backbone of DeFi, securing tens of billions of dollars in TVL across hundreds of live applications, publishing more than 16 million of data points on chain, supporting more than 2,300 integrations across established and emerging blockchain protocols. So we operate DeFi at scale, and we're leaning on that experience to also help TradFi come on chain, so to say. With that in mind, I am actually very thrilled to be joined today by some of the sharpest minds at the intersection of staking, custody, investments, and traditional finance. I'd like each of them to shortly introduce themselves and perhaps share a few words on how they're thinking and working on this ever-evolving space around staking and ETFs. Lorien, perhaps starting with you first.
Good to see you again. Artiona was one of the first employees at Figment for many years, and we worked together, so it's great to see her again. So now she's moved on, but it's good to see you, and we miss you. Lorien Gabel, I'm CEO and co-founder of Figment. I think we're the world's largest independent staking provider. We work with a number of people here on stage. Galaxy is now a competitor, but also an investor. So it's good to see you all also. I have a fair amount I think I can provide some updates on, specifically in the U.S. and the regulatory environment. We've been working pretty extensively over the last 2 or 3 months with the new U.S. regulatory regime, and things are about to change pretty significantly with respect to staking and the U.S. ETFs. So look forward to talking about it.
Hello, everyone. My name is Kean. I've been in crypto for around 8 years, started my career in Deloitte doing FS capital markets consulting on crypto. Then I was in Consensus for around 5.5 years, mainly working on MetaMask Institutional and Fura staking and a number of other products. And now currently I'm a contributor to Lido when I focus on Lido Institutional. So really, Lido Institutional's mandate is to grow adoption of stETH, Lido's liquid staking token, among institutional users. So crypto funds, asset managers, hedge funds, anyone who holds a significant amount of ETH. And we'd obviously encourage them to stake it with Lido for the added benefits of liquidity and capital efficiency.
I am Jake. I'm the head of ecosystem at BitGo. Came into BitGo about 1.5 years ago when my company Height Zero was acquired by BitGo. So started out on more the financial advisory and then ultimately token management side. Here on the ecosystem team, we onboard labs, entities, protocols, foundations, and help deliver them the entire product stack of services that BitGo has to offer, which includes custody, staking, trading, borrow, lend, OTC, and others. So on the staking side, we work with a lot of financial institutions, work with companies like Lido, work with companies like Figment, work with companies like Galaxy to help deliver all of those services. So we are very partnership driven, and it's nice to be sitting here up on stage with a bunch of other partners that we are so closely aligned with.
Hey guys, I'm Neil. I work at a firm called Galaxy. We're a large publicly traded company in the crypto ecosystem. We touch a number of different areas of crypto, but I think as it relates to the topic of this discussion, particularly around staking and ETFs, we have a dedicated staking and node infrastructure team. They run validator nodes and provide institutional staking for different clients of ours, as well as running different Bitcoin mining hubs as well. And then I think on the more asset management investment side, we partnered with Invesco on an ETF product, both for Bitcoin and Ethereum as well. And then on the more investment side, which is where I focus on, as Lorien mentioned, we're investors in Figment, amongst other staking providers. And we generally view staking as pretty critical infrastructure in the ecosystem and are always looking at kind of what is the cutting edge there that we could be investing behind as well.
Awesome. Thank you all. It's clear we have an incredible experience here on stage, ranging from staking providers, custody providers, investment. Perhaps to kick this off, let's zoom out a little. Like we spoke about this crypto evolution of the cryptos ETFs as a normal thing, as something we should accept and we should embrace, right? But staking is a construct very inherent to blockchain itself, which is designed for crypto native participants, right? So naturally, my first question perhaps goes to you, Lorien. What does it actually take to bring staking to these structures? Like what does it take for staking to appeal to fund managers and being wrapped around these staking ETFs? And what are some of the differences that you see between someone who's within the retail ranges versus institutional fund managers or RIAs and so on and so forth?
Great question. So I think there's two main things that at least we've done with the U.S. Issuers. First is there's primarily been a regulatory blocker in the U.S., or at least uncertainty, which has prevented the U.S. ETFs from enabling staking within, for example, like the Fidelity ETF. And so they've just been unwilling to take that risk, and they really wanted to get their initial filings approved. And so they've excluded staking from the US ETFs. The rest of the world, whether it's 21 shares in Europe, 3iQ just launched in Canada, for example, on the Solana with staking. Basically, they are probably a year ahead of what's going on in the US. The SEC, since the election, has been much more open to hearing the staking. As Artiona pointed out, is you can't really have Ethereum and not have staking. It doesn't make any sense. It's like having Bitcoin but then banning mining. Like the two have to go together. So in the States, it was very inconsistent. So Ethereum was not a security, yet large institutions wouldn't do staking because of the regulatory unclarity. So there's like a big contradiction there. And so you can't really have both those things exist at the same time. The SEC will, in the next 30 to 45 days, be coming out with guidance, which it will essentially provide comfort and direction to all the U.S. issuers around staking, certainly Ethereum and probably other protocols. So that's going to happen relatively shortly, and it will be a big change. So that's number one. And then there's just an educational function. I would say these institutions have very little idea and a lot of misunderstanding around exactly what staking is. It's kind of a new concept, especially for TradFi. It doesn't really, there's no perfect analogy in the TradFi world. So really just explaining the basics around the risks, slashing, around the fact that it's non-custodial, which is a pretty difficult concept actually for them to understand, that there's no counterparty risk, etc. So it's really been a function, primarily of the regulatory uncertainty, and then just the basic education you would do with any new customer who doesn't have any clue what staking is.
Great. Makes sense. Kean, how do protocols like Lido adapt with this new type of exposure? And would you say liquid staking is more of a friend to staking ETFs or a complication?
Good question. So I'd say from a Lido perspective, the key thing for us right now is building this institutional narrative and making sure that they know that Lido is institutional grade. I think one of the great things that Lido has done in the past is built this depth of liquidity from a retail perspective. Now the job is to take that depth of liquidity and present it to institutions. That's the first thing. The majority of the ETF, ETP issuers that we speak to, they want to see that depth of liquidity. They want to know how much they can sell, how long it takes to sell. And by far, Lido is the largest liquid staking protocol today, and no one can really come close to that. In terms of the core activities that the institutional team and others are taking right now, you've probably seen the panel yesterday, or the presentation, I should say, from Will Shannon around ST Vaults and Lido V3. So this is kind of the first kind of dedicated move into building an institutional product with specific features more tailored to what an ETP or an ETF issuer might want. So specifically, feedback we've kind of heard before is that the idea of using Lido Core and not knowing who it's staked with can be a bit of an issue. Especially a lot of these issuers, they're quite low on the risk scale. So the whole idea of ST vaults is this idea of choosing the node operator that you can stake with, but still have the ability to mint ETH.
Yeah, actually, that's just with one point. One of the which they may eventually be able to play a role in is that another big issue is the redemption period and unbonding
This
period.
is why I precisely asked about friend or complication, because I would think that that's, like a natural add-on and a hopeful to staking.
Yeah, exactly. So like if you think of native staking in ETPs today, only 50% of the AUM is staked. And the reason for that is the redemption period, like you mentioned. So the whole idea of using ETH within this ETP structure is you can go from 50% staked right up to 100% staked. So that benefits two groups: the issuer in the sense of they have a superior product, and then the investor, they get a higher return.
Awesome. So we're still, at the how of this. So Jake, naturally, custodians play a major role in helping staking ETFs go to production, right? Like, how do qualified custodians like BitGo engage in the process? What are some of the risk and operational processes that revolve around you guys supporting major staking ETFs being launched?
Yeah, so I mean, it's a pretty straightforward thing. This is exactly what BitGo and other qualified custodians are built for, right? We've been institutional focused for so long. We have all the infrastructure in place where you can stake through partners or stake to your own validators or access specific permissioned validators or permission networks that they need to access for regulatory reasons in certain jurisdictions. And you can do all of that from BitGo really easily. So as far as licensing goes, we're already pre-set for anything that could happen in the US right now. The problem that we're facing right now, and is the same problem that is happening to everyone who wants to build more products or just more market infrastructure in the United States right now, is lack of regulatory clarity. So like even us, and in working with Lido, we do not have enough clarity on whether or not even issuing these LSTs from BitGo could look like a security or is a security. So we are just completely blocked from progressing from a technological front where we need things like rebasing to be able to support Lido, which is something we haven't built, because without that clarity, there's no point in pushing that forward.
Yeah, and I think there's a lot of appetite recently from the regulators to be engaging in this type of conversations, which is like very encouraging to the space. Obviously, with the launch of the Bitcoin ETFs last year, this was, like I would say it was a major success. It's a little bit of perhaps too much to ask them, to pivot from that proof of work history and story to proof of stake and having them understand the space. Like it's a pretty big change for them, right? But it seems encouraging to see that they're open, so they've been sending questions around. So I'll get towards the end of it. How are you guys projecting the space to evolve in 12 months? It's like the standard, close up questions and so on. But maybe another thing for you, Jake, I do understand how staking providers pitch, to win this competitive space of supporting the staking ETFs, but how do custody providers pitch in that perspective? Like what differentiates BitGo from another qualified custodian?
Well, our services stack is very important. We recently peaked at over $48 billion of assets staked, which is more than any other provider. I mean, with the exception of Coinbase, but Coinbase's numbers are a little hairy, depending on how you look at them. So showing that we have such trusted history of being able to support such a large value of assets helps make a lot of these other ETF providers and issuers feel comfortable. Plus, we've been around the longest, and we've been institutional focused the entire time, with the exception of some recent forays into retail. But with that very strong history serving the exact type of institutions that are launching these things, it's an immediate level of comfort. Plus, we've never lost a cent of client assets. Everything is insured, running out of qualified cold custody. This is our bread and butter.
Yep, makes a lot of sense. It reminds me of the stories coming from various emerging staking providers saying that they've never been slashed, but they've been operating for 3 months only. So I guess track record in the space is a very important thing to prove, right? Neil, let's move on to you and let's talk a little bit about the mechanics of it, like yield, NAV, and validator choice, right? How are ETF issuers thinking about staking rewards in terms of NAV and yield distribution? I have to use the term yield in this case. Are there emerging standards for how yield is measured and reported based on your observations?
Yeah, I would say maybe taking the first part of the question, I think the way ETF issuers fundamentally think about it is staking rewards are treated as a source of yield on the underlying assets in the kind of ETF. And then from there, there's really kind of a key question of what to do with the yield from the ETF manager perspective, right? There's fundamentally two choices. One is you could kind of auto reinvest the staking rewards into the ETF, or you can have some sort of capital distribution, kind of similar to like a dividend in a stock ETF, right? I think generally in the market, what we've kind of observed so far is you've generally seen ETF issuers lean towards the auto reinvesting strategy. I think primarily for two reasons. One is it's generally a bit more tax efficient as opposed to having to kind of deal with the dividend style income that you would get if you're kind of regularly distributing the staking rewards. And then secondly, I think by not distributing the rewards and kind of auto compounding them, you generally kind of see more of the capital appreciation strategy, which kind of fits into the overall kind of growth narrative of these staking ETFs. And then I think on the other side of your question around regulatory disclosure, there's, I think, a couple different components to it. I think one is reporting standards. And I guess maybe taking a step back, I would say it's still very much in its nascency, but generally from what I've seen, you kind of have to look at gross versus net staking yield, right? Because ultimately you have to net out the validator fees, the custody fees, any slashing reserves you might have to account for as well. So I think that's one key component. And then I think the other kind of key component as well is the risks involved, right? So there's slashing risk, validator concentration risk, downtime penalty risks as well. So I think kind of having more proper risk disclosures as well around that is going to be very important as well going forward.
Makes sense. At this point, like a question perhaps to you all, and maybe starting again with you, Neil, since Galaxy operates, one of the largest validator infrastructure in the space, and you guys have also been around for a long time. Let's talk a little bit about validator choice and picking or going for, the preferred validator provider when launching a staking ETF. I haven't seen any announcement that goes primarily with just one staking provider. Typically, these staking ETFs differentiate. They like to think of it as not putting the same eggs in all of the eggs in the same basket. Should we think of this as a win-win situations? Like, are there any hard feelings, behind the scenes and all of that? Like, do you really think that, validator providers think of each other with the same, appraisal of their own operations, like in your case, Galaxy, for example?
I mean, I think I'll give you the simple answer, which is I think it kind of comes down to the regulatory aspects, right? Like, ultimately, we need to have validator support on the back end that's very kind of regulatorily compliant, particularly kind of at an institutional grade. I mean, Galaxy is like a publicly traded company, so I think we're very kind of discerning and careful as it relates to that. I think from our perspective, that's really kind of one of the key differentiators as we kind of evaluate these things.
So we should think of it as it has become the norm for a staking ETF to include several staking providers. Jake, would you say so?
Sorry, could you just repeat that?
So we have rarely seen staking ETFs primarily relying on just one provider. It's typically two or more.
Yes.
Sometimes four, that has become the standard. How do you see that?
Well, it's just intelligent planning and decentralization, right? You don't want to overweight with a single provider for any purpose. I mean, it's the same reason why a lot of these ETF issuers are using not just BitGo, but they're using Coinbase, they're using Acreage, they're differentiating where they're holding all of their assets. That same risk could be said to be true about these validator partners that you work with as well.
Lorien, what do you think about that?
There's the sales process for the ETFs looks like this. You spend 2 years building the relationship on the regulatory front. So talking to their regulatory people, giving them updated information, doing joint submissions to the SEC, building that relationship. And then there's usually an RFP process, which is a 50 to 200 page RFP, which has a huge amount of sort of basic TradFi corporate requirements around certification, et cetera. And within that RFP process, there's usually 2 to 4 providers. I've seen 3 is the most common one. And then those are usually a fairly, to be straightforward about it, a fairly hard-fought battle around that RFP process. And that RFP process can take, 2 to 3 months, depending on, sometimes longer, depending on the institution. And then that the final decision is made. And what we've seen, it's either 1 or 2 providers for the 8 or 9 issuers. They're easier going with one provider initially, and then they'll have a backup one. And it's very competitive, and it's very meaningful because the numbers are huge. So it's not that friendly at all.
Yep, let's call it a win-win for everyone.
Artiona,
There's no win-win. There's just a win-loss.
Artiona, do you mind if we spice this up a little bit? Because like when I
was told to spice it up, like from
when I was not hearing your question a second ago, I was thinking about how a lot of crypto, like I've been in crypto for 12 years, so there's been this mantra that the herd is coming, like institutions are coming. I think institutions are here, and now everybody's still trying to make further excuses on why they're not participating more in what is really an open market. And so now we're building these retail-focused products, which are ETFs, ETPs, and hoping that that's going to bring more institutional volume. And that's going to be the market structure they need to like really move this forward in the next step. And then staking ETFs, and then liquid staked ETFs. So what do you guys, any of you up here, because I think all of your opinions are valuable on this exact topic, do you think that this is the answer that we've been looking for? Or do you think this is just another pebble in the many pebbles that are building stepping stones for us moving forward from a retail focus to an institutional focused space?
Well, go ahead, Kean. Yeah.
I'll take a stab at it. I think, I agree with you in the sense of the pebble analogy. I think it's part of the broader stack of how institutions want to engage with DeFi and staking. At the end of the day, an ETF is trusted by institutions. There's regulatory clarity. There's also a significant amount of easiness to get exposure to ETH and staked because you have terrific providers like BitGo being the QC, you have Figment as the node operator. So as an institution, it's just incredibly easy to go down the route of an ETF. I think, again, to your point, the regulatory clarity is kind of the big hurdle right now from at least a US ETF perspective. In Europe, staking and ETPs have been around quite a long time. So at least from a liquid staking angle, Steth has BaFin approval, FINMA approval, it can be listed on a number of exchanges. So I think, again, going back to the broader education point, until you have the regulatory ticks, education aligned, it just takes time.
So are you more hopeful or are you more confident?
For a Lido staked ETP, I'm incredibly confident. I think, again, when things open up in the US, you will see a liquid staked ETF.
What about actual adoption, though? It's one thing to launch a product. It's another for people to care.
I would say BlackRock, Fidelity, Franklin Templeton, they don't place bad bets.
They place hedged bets where it doesn't need to be massive to be successful.
And I believe, Jake, there was this study whereby the volumes being generated from the RAs had actually surpassed those of fund managers ever since the Bitcoin ETF launched last year, which is actually very encouraging to see, right? So people are paying attention. I think it's more the natural, the natural path of education and the fact that this takes a while, but we're actually seeing good adoption, and we're getting there. Perhaps it differs at different stages, but I would say that the Bitcoin ETF and the launch last year was a success. Would you guys think differently?
No, I think it was objectively a success. If you look at kind of the AUM that Bitcoin has been able to gather in the ETF space, I think that's also kind of positively contributed from a market perspective and kind of how well it's held up in this kind of period of macro uncertainty as well.
Right. Cool. Kean, I wanted to chat a little bit about the fact that Lido has really been the epitome of really cherry picking the underlying validators and making sure that they fall under the ops framework that complies with your, rules and your standards, so to say. But you kind of hinted that direction, and it's like seeing that you're hopeful for around the liquid staking ETFs being approved is actually very, very encouraging to see if you have some more notes to add to that.
Yeah, I would say there's big news to come, which is terrific. I wouldn't exactly say we cherry pick node operators in the sense. I think the focus for Lido has always been to work with tier 1 players like Figment, Kean, Chorus One, P2P, and again, from a broader institutional perspective, my focus is to build out this ecosystem around Lido Institutional. So again, working with guys like BitGo, Copper, Fireblocks, like that's a big part of it. So again, kind of back to the ETP piece, like you need to have all these different pieces of the puzzles before an issuer actually launches a product. And again, I would be quite confident we could do something pretty soon.
Great, awesome. Perhaps in this last part, let's touch a little bit about on the regulation side of it. Like, obviously, there's been a lot of discussions around staking ETFs. Like, you guys stay in close touch with the regulators. Like, Neil, starting from you, perhaps, what's the latest and greatest, like, that you hear on that front?
Yeah, I mean, maybe I'll segment my answer by geography. I think generally you've seen like further development from a regulatory perspective in both the EU and Singapore. I think in EU, you obviously have the micro regulations coming online. You've seen some ETP products in Germany in particular start to integrate staking, which I think has been a very positive development. I think in Singapore, I would argue they probably have the clearest regulatory framework in place today. Unfortunately, though, I don't think that's quite translated into like actual integration of staking into the ETF products in Singapore yet. But I think probably my guess is over the next 12 to 24 months, that'll start to change. And then, to state the obvious, I think the US historically has been kind of the furthest behind and generally the most reticent to integrate staking into the ETF products. Obviously, I think you've seen somewhat of a change in posture from the SEC in particular as a result of the change in administration over the last few months. So I think that's an encouraging sign. But I think there's still a lot of wood that needs to be chopped in terms of developing a more coherent framework in the US. Yeah.
I'm going to double down on what Neil just said there too, and that's that we've seen cases getting dropped. We've been told that these guys are all very crypto friendly. We've been told regulation is coming, guidelines are coming, but we've yet to see anything material come from it. So that's this whole wait and see where a lot of cryptos like the dog that's been chasing the car. Now we finally caught the car, and we don't know what to do about it, and we have no guidelines on how to handle the car. And now we're just sitting here waiting, right? And like everybody feels pretty bullish from the outside looking in, but sitting from the inside within crypto, it's not massively different. I mean, sure, if you're Coinbase or you're Kraken and you're no longer being investigated by a 3-letter agency, that feels pretty good and feels like progress, but there's still not been much from actual framework that's come out of this. And from a staking ETP side, ETF side, we probably won't hear anything by the end of the year or until near the end of the year.
No, I think you will in the next 6 weeks.
You think 6 weeks? Because can't they push until end of 25?
You can buy me dinner.
I thought it was October. Okay, deal.
Okay.
Awesome. Like, Jake, would you say that staking actually really moves the needle when launching an ETF? Like, is staking going to be that product differentiator that incentivizes, fund managers whatsoever to purchase that product? Or we are yet at the, getting everyone educated and all of that?
My answer right now would be no. I don't think it's enough to move the needle, but it's back to both of their points around the fact that education needs to come first. And if you educate them in a way that you show them that the yield that's being added to that fund helps make it so they're basically investing in the same product, but having some additional yield and not having to pay any fees at all because it's being covered by the revenue being made from that staking, then all of a sudden that becomes a lot more attractive to them. Because I think staking is a pretty esoteric thing to understand as a institutional investor. And so you really need to spin it in a way that just is, this is a product, you're getting access to this asset on the back end, and then this asset is generating this yield. and then it becomes a bit more attractive. But I mean, it's something that once it exists, you can go out there and sell it. Before it exists, it's not being pitched as heavily.
Ken, would you agree?
You know, I 100% agree with Jake. I think it's not that exciting if you're to launch another ETH staking ETP ETF that's 50% staked. That's like, at least from a European perspective, the market is flooded with these products. I think what is exciting is 100% staked ETP with a cheap TER in Europe. I think that is exciting and that could move the needle.
Got it. Well, approaching the end of the panel shortly, we have to wrap up. It looks to me like we still have a long way to go when it comes to education, but it's ultimately like a thing that is going to come and unavoidable because it just makes sense. And the natural add-on to perhaps the Ethereum ETF, but more ETFs to follow. I've seen a lot of new ETFs being filed recently on Avalanche ETF and so on and so forth. Perhaps let's wrap it up with a note on what would you like to see and what do you think would realistically happen, like if we were to be here like in 12 months around staking ETFs, adoption, and regulatory clarity.
I hope Lorien is right, and in 6 weeks everything's looking nice and clear, and we can keep moving this forward.
Everyone here, or many people here, joined the space to disintermediate the largest financial institutions, and we're all just going to get BlackRock t-shirts. So enjoy it.
Awesome. Neil, Kean, like any final comments from your side?
I mean, I would say I think there were some comments in the panel about like, TradFi doesn't understand like staking. It's like too complex of a subject for them to like grasp in their small brains. I think I would kind of take the other side of that. I think like generally in my experience, like having worked in TradFi before, like they're generally pretty sophisticated people. I think they generally understand staking, and I think Wall Street is always looking for new, different, uncorrelated sources of yield. And so I think when those sources of yield in the form of staking are more readily accessible to them with kind of clear regulatory frameworks in place, you'll see a lot of capital flow in that direction.
Awesome.
Yeah, I agree with the three gentlemen. I think everything they said is true. I really hope that staking in ETFs is approved soon. We can share a dinner. My focus is obviously to ensure liquid staking is also included. And I think, again, that will be a big part of what I would love to see in 2025, native staking and liquid staking.
Awesome. Thanks, everyone. I enjoyed the conversation. Hope you did as well, and I hope it was helpful for the audience. We will be around, except Lorien, who's running to catch an interview, I think, right? So, yeah, enjoy the rest of the Staking Summit.